More money making. Today I want to talk about the main asset classes you can invest in within your portfolio, how they generate returns, what the risks are, and how liquid they are. As always, if you like what you're watching, please destroy the like and subscribe buttons and notification bell for the YouTube algorithm. Asset classes are defined as groups of investments which have similar characteristics and behave in a similar way. How you decide to blend together these different types of investments will determine your expected return, risk, and liquidity. Complementary asset classes can actually reduce the total risk of your portfolio. Most investment opportunities can be categorized into three groups. Equity investments, which is partial ownership of a business through being a shareholder. Fixed income investments, which are loans or cash deposits made to businesses, governments, or individuals. And property, which is ownership of buildings or land. Most pension schemes and investment portfolios are mainly invested in these three asset classes, with only a tiny portion in other investments. Equities and bonds, in various proportions, are the core holdings of virtually every retail investment portfolio. Other investments are commodities, hedge funds, venture capital, currencies, cryptocurrencies, collectibles, and structured products, which I'll discuss in the next video. First, let's talk about equities. In terms of returns, a share of company profits, called dividends, are paid at the discretion of management. As a company's prospects change over time, the price per share on the stock market will also change, and a shareholder can choose to sell their shares for a capital gain or loss. In terms of risk, of all the groups that provide finance to a company, shareholders carry the most risk. In the event of a bankruptcy, all other parties, such as employees, suppliers, the tax authority, lenders, and so on, must be repaid in full before shareholders. Shareholders will experience ups and downs in the share price due to shareholders and potential buyers continually reassessing the value of the company in light of the most recent news and economic data. Returns can be volatile in the short term, but over the medium to long term, equities return around 10% per year on average. In terms of liquidity of equities, shares in companies publicly traded on the world stock exchanges with the help of stockbrokers are a very liquid investment, where liquidity is the ability of an investor to convert their investment into cash in a short space of time. You would normally allocate most of your equity investments into large and mature businesses listed on the stock exchanges of developed economies, such as those of Europe, North America, and Japan. But you can also allocate a portion to high-growth economies called emerging markets, like China, India, and Brazil, that have higher prospects for growth, but also even higher volatility due to political and social instability, lighter regulations, and less effective rule of law. Now let's talk about bonds. In terms of returns, bonds are a form of loan agreement which can be traded between owners, known as bondholders, so they share similarities with a fixed-term savings account. The bondholder receives scheduled interest payments called coupons, and in most cases the full repayment of the lump sum amount called the principal at the maturity date. Even though the market value of the bond can fluctuate over time, just like a share, the value of the coupons and principal will not change, so if a bond is held to maturity and the company does not collapse, the return is effectively fixed, which is called yield to maturity, or YTM. In terms of risk, the key risk is credit risk, where the business struggles and is unable to pay the coupon or repay the principal of a bond. In the event of bankruptcy, bondholders need to be repaid in full before shareholders, so bonds have less risk, but it's still unlikely a bondholder will receive much. Another key risk for bondholders is that if the returns of other investments rise for any reason, the YTM on your bond becomes lower in comparison. Equally, if the returns on other investments fall, your YTM looks more attractive. In terms of liquidity, a bond can be easily sold to another party for cash, unlike a fixed-term bank account which may commit you to keeping your money in there for a fixed period. In practice, retail investors rarely invest directly in bonds because the minimum trade size in the bond market is high, for example £5,000, so it's expensive to diversify across multiple bonds. What virtually all investors do instead is to buy units of a collective investment vehicle, such as a mutual fund, which then distributes the coupons to unit holders by way of a dividend. Like equities, mutual funds traded on the world's stock exchanges with the help of stockbrokers are a very liquid investment. Bonds are normally separated into corporate and government bonds, which are issued by companies and central governments respectively. The key difference is that a government can often provide absolute assurance the bond will be repaid by printing more money, since governments typically issue bonds denominated in their own currency, even if this does then devalue the currency, whereas companies can go bankrupt. This means that investors are prepared to accept a much lower rate of return if it is more certain. As mentioned before, you may not receive much as a corporate bondholder if the company goes bankrupt. During a financial crisis, investors tend to fly away from risky assets and into safe havens such as government bonds, making them appreciate in value while other asset classes plunge, thereby acting as a stabilizer. Now let's talk about property. In terms of returns, property investments provide rental income from letting the property out to tenants, as well as potential capital appreciation through inflation and development or extensions. Investing in land is more speculative because an unused parcel of land does not generate rental income. In terms of risk, as a landlord, you may be drawn into issues with troublesome tenants, damage, and void periods. It can also be difficult to diversify since you may not be able to afford to own more than one investment property initially. As an investor in property development companies, your investments could lose significant value in a downturn. Property prices usually trend up, but for example, in the aftermath of the financial crisis in 2008, some properties were worth half of their original value after the crash and still haven't recovered to their previous high. In terms of liquidity, property is difficult and costly to transfer between two parties, and the process normally takes quite some time. Properties can be sold quickly through auctions, but at the expense of not achieving the full market value. So, how do you go about constructing an investment portfolio? There are, of course, an almost infinite number of possibilities, but there are some common approaches we can look at. Sometimes an effective investment portfolio contains nothing more than equities and bonds. In general, the younger you are, the more heavily you should be invested in stocks, since you have a long time period ahead of you to average out any short-term volatility. As you approach retirement, you may want to add more bonds. A decent rule of thumb is for the percentage of stocks you own to be equal to 120 minus your age. In the next video, I'll discuss alternative asset classes. Thank you so much for watching. I really appreciate it. Please add your own thoughts and follow-up questions in the comments, and I'll try to get through as many as I can. If you made it to the very end, please destroy the like and subscribe buttons and notification bell so you never miss a chance for more money making.